Today we're diving into a super important topic for every business: working capital. It sounds like complicated financial jargon, but don't worry, by the end of this video you will understand exactly what it means, how to calculate it, and why it can make or break your business. What is working capital? Let's start with the basics. Working capital simply means the money a business needs to run its daily operations, like paying suppliers, employees, and keeping inventory stocked. In short, it's the lifeblood of your business, the cash that keeps everything flowing smoothly. Here's the simple formula: working capital equals current assets minus current liabilities. Let's break that down. Current assets are the things you own that can be turned into cash within a year, like cash itself, accounts receivable, money your customers owe you, and inventory. Current liabilities are what you owe within a year, like bills, short-term loans, and salaries you still have to pay. So if your company has $200,000 in current assets and $120,000 in current liabilities, your working capital is $80,000. That's your cushion, your short-term financial safety net. Why working capital matters? Think of working capital like fuel for your business engine. Without it, even a profitable business can get stuck. If you have too little working capital, you might struggle to pay your bills or keep your operations running. But if you have too much working capital, it might mean your money is just sitting idle instead of being invested to grow your business. So the goal is balance. You need enough liquidity to stay flexible, but not so much that your funds are wasted sitting in your bank account. Positive versus negative working capital. Let's talk about the two types. Positive working capital. This happens when your current assets are greater than your current liabilities. It means your business can easily pay off its short-term debts, a sign of financial health. Negative working capital. This means your current liabilities are greater than your current assets. You might struggle to pay your bills or buy new inventory, which can be risky if it continues for too long. Imagine a company has $50,000 in assets and $70,000 in liabilities. That's negative $20,000 working capital. They'll likely face cash shortages unless they find some more funds or reduce costs quickly. How to calculate working capital? Let's make it practical. The basic formula again is working capital equals current assets minus current liabilities. But there's more. You can also look at working capital ratio, which gives a clearer picture. Working capital ratio is current assets divided by current liability. For example, if your assets are $200,000 and liabilities are $120,000, then your ratio is 1.67. That means for every $1 you owe, you have $1.67 available. Pretty healthy. Less than 1 means not enough liquidity. Risky. Between 1.2 and 2 is ideal range. Above 2 is too much idle cash. Consider reinvesting it. Managing working capital effectively. Now that you know what working capital is, let's see how to manage it efficiently. Improve cash flow. Collect payment faster, send invoices on time, offer small discounts for early payments, and use digital invoicing tools. Control inventory. Do not overstock. Too much inventory ties up cash. Use techniques like JIT inventory to keep your stock lean and efficient. Stretch payables smartly. If your supplier allows 30 days to pay, don't rush to pay in 5 days. Use that time wisely, but never delay payments irresponsibly. Plan ahead. Forecast your cash needs for the next 3 to 6 months. That way, you will spot potential shortfalls before they hit. Reinvest wisely. If you have surplus working capital, use it to expand your business. Invest in new equipment or pay down debt. Let's look at two quick real-life examples. First of all, a retail shop. A clothing store needs to buy inventory before each season. They pay suppliers upfront but only get cash once customers buy the clothes. So they need strong working capital to cover that gap. Another example would be a software company. The company collects subscription fees in advance. They get cash early, so they have negative working capital. And that's okay because their cash flow is positive. Working capital is not one size fits all. It depends on your business model. Common mistakes businesses make. Here are a few working capital traps you should avoid. Ignoring overdue invoices, keeping excess inventory, not forecasting short-term cash needs, using short-term loans for long-term assets. Remember, good working capital management is all about timing and balance. Quick recap. Let's wrap up everything we learned today. Working capital equals current assets minus current liability. It measures how much liquidity your business has to operate smoothly. Positive is good, negative can be risky. Ideal ratio is between 1.2 and 2. You need to manage it by improving cash flow, controlling inventory, and forecasting ahead. And that's it. You now understand working capital in simple terms. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell for more business and finance breakdowns every week. Drop a comment below if you want me to explain cash conversion cycle next. It's the next step after working capital. Thanks for watching and see you in the next video.